All right. So before I get into the alternative types of capital stock, let's talk a minute about how deals often get done in this industry. For better or for worse, financing, capital financing in the cannabis industry is unlike anything else. It's unlike any other industry. Part of this has to do that traditional banking, traditional lending, traditional capital markets are not available to you as cannabis businesses. That sort of sets you behind the eight ball out the gate in terms of how do I go about raising capital, right? We talked about how lenders give you capital in exchange for a promise of repayment and interest on that repayment as their return, and that's enough. And we've talked about how equity investors give you capital in exchange for an ownership interest in your business. That's not exactly how it works today in the cannabis industry. And we are working every day to change that. We are working every day to normalize how these cannabis businesses can go about capital financing. But until we see some policy changes, whether at the federal level or at the corporate level around banking and finance, you're going to run into challenges, right? Most deals to raise capital in this industry are hybrid deals. I'm being generous with that. They're mostly double dipping. What you will, and for those of you who have already started some of these conversations, this may sound familiar to you. Oh yeah, we'll invest in your company. We're happy to partner with you, but I want my investment treated as debt so that I get paid my return on top of the debt, often with priority. But I want the equity also. They're asking for both for the same amount of money. That doesn't happen in any other industry. I've spent 12 years doing cannabis work. Before that, I was doing business and tax work. I've done financings in a lot of different industries. Only in this industry, particularly in the equity space, have investors been able to get away with this. They will ask for their money, 100% of it to be treated as debt and paid back with interest and priority. And they want the equity also. Well, how do you justify the equity purchase if we're going to be paying this debt back? And they almost treat it as that's just a condition of doing business. They're taking advantage of the fact that they believe you have nowhere else to go. Okay? They're taking advantage of the fact that they can convince you that somebody else will take that deal because other people have. And so that's why we're doing workshops and information sessions like these here today to put you on notice so that you know what to expect. You know what to look out for. Don't get me wrong. Accepting debt is a legitimate way to capitalize your business. But there's something pernicious about the double dipping nature of the way some of these deals are structured. Typically, I go in and I ask, well, can we bifurcate this? Can part of your investment be treated as debt? And can part of it be treated as an equity purchase? Or if we have to have debt and equity also, can we do something around distribution rights? Because what you'll see is some of these debt deals will consume all the profits early in the business. And so you as the equity partner could be sitting there not seeing any return for the first 24 months, 36 months, if your business gets off the ground well, because all that money is paying off the debt. So we've had some success in that regard. Okay, we have to treat it as debt to get the funding in. Can we limit the debt service to 50% of the profits? Can we limit it to 40% of the profits? Can the balance of that then be split according to equity ownership? And we've had some success with that, but you have to know to ask for that. They're not going to tell you about how else to structure it. What they're going to tell you is, this is the deal. I can't really do it another way. So are you going to take it? You have to resist that pressure. It doesn't help if you have looming deadlines for when you have to get open, or if you have looming deadlines about when you have to move to the next stage of the process. But that's why it's so important to start having these conversations early, because we need to be creative about how we are structuring these deals. And I'm really sensitive to the fact that the equity participant, the equity qualifier, and let me just digress a little bit. They would not have a licensing opportunity but for you. There's value in that. They may not want to recognize that value. They may not want to acknowledge that value, but they would not have this opportunity but for you. And if you are grant eligible through the City of LA's program, that is more value that you are bringing to the table. If your business is equity qualified, you are eligible for fee waivers at the state level now. That is value you are bringing to the table, all of which needs to be recognized. So what you see on the screen here right now are two alternative types of capital stock that may be important for these conversations. The first is preferred stock. This is equity capital, whether it's preferred stock in a corporation or preferred membership units in an LLC. This is still equity capital that they have to buy into. Preferred stock usually has certain preferences afforded to it. And for capital partners who are flexible in the deal structure, this may be something that works for you. They're often going to say, we're the only ones putting up the money. I need some sort of priority here. Okay, well, we can give you priority if you're willing to accept preferred stock, right? Preferred stock may not have the same voting rights that your regular common stock would have, but they may be able to enjoy a benefit in terms of distributions, right? And the way we have tried to structure these in the past, tell the capital partner, we understand that you need your money back. Accept this preferred stock. You will get priority on distributions. It's okay. You'll get priority on these distributions until your capital has been returned to you. And then your preferred stock converts back into common stock, and everybody's on the same playing field. Another way to think about that, particularly in the LLC context, is including what we would call a sunset provision, right? So they may insist on some sort of preferential treatment based on the fact that they're bringing the bulk of the money. Okay. Can we sunset that preference? Can we end that preference once your capital has been returned, and then get everybody back on a level playing field? you will experience resistance to these suggestions. And I'm looking at some of the room, and I'm sure that some of you have had these conversations already. But you need to be creative in the different ways that you can structure these deals, and you need to present those alternatives to the investor. It's not their job to come up with your offer. Let me reiterate that. It is your offer. They can't force you to give up a piece of your company. They may try to present something to you for you to accept. But at the end of the day, it is the company's offer, even if somebody else writes it for them. Let that sink in. If you need to keep on negotiating to get something more favorable for you, if you need to move on to a different prospective investor, make the decision that's right for your company, right? So you can offer them preferred stock. You can take a look at including sunset provisions in your partnership agreements. But I also want to talk about a class of security that is beneficial to you as the equity partners. Okay? And that's the other one you see on the screen, what we would call guaranteed stock or guaranteed membership units. This is where the company needs to guarantee a certain amount of payment to the partner holding that interest. I think it is fine for you to ask that your interest in the company be treated as guaranteed stock. If they're going to insist on a preference, if they're going to insist on their investment being treated as debt and being repaid with interest in addition to equity, I think it is fair for you to ask and insist upon your interest in the business being guaranteed. And whether those payments come directly from them as the investor, or whether those payments are coming out of operations of the business once it gets started, I'm comfortable either way. But what this allows for you to have some security around what you will get out of this game. You don't want to be stuck watching your business pay the investors back for the first 2 to 3 years before money eventually flows to common stockholders. A guaranteed stock issuance can eliminate that concern. And even if the company can't afford to pay it immediately out the gate, those guaranteed payments can accrue over time, just like the value of their debt can accrue over time with the interest. Okay? So those are just a couple of different ways to think about how they might hold their stock and how you might hold your stock in the business. So we've mentioned some other sources of capital funding already. The DCR does have a grant program. Government grants are big. You are the ones, the people in this room are the ones making the businesses eligible for these grants. So I think it's a mistake not to go after some of these government grants, but I want to give you a couple of pointers to think about as you apply for these grants. Number one, any grant funds that come into the business based on your eligibility should be credited to your capital account. Not just that this is money the business brought in the same way the business brings in revenue and doesn't have any impact on the capital accounts. This is money that the business could not obtain without you. And if the business receives these grant funds, it should be credited to your capital account. This is one of the traps that I've seen partners engage in. They'll insist that you go out there and you sign off on this grant money. They'll fill out the paperwork. They just need you to sign off on it. And when that money comes in, they don't treat it as though it was a contribution coming from you. It needs to be treated as a contribution coming from you in all cases. The other point that I want to talk about with regard to the government grants has less to do with the business and more to do with you individually. Grants are taxable. Grants are income. If you take one of these grants in your name, that is income that you need to report on your tax returns. For those of you who receive public benefits, if your public benefits are means tested or asset tested, taking a grant in your name could trigger all sorts of negative impacts for your public benefits. I did see a hand up. There will be a Q&A session later today. But just know that ideally you want to apply for and accept that grant money in the name of your business. These businesses often take time to get started. Very few operators are open in their very first year. And so typically the first year or two, these cannabis businesses are incurring losses, right? So it's fine to accept that income, that grant income to your cannabis business, particularly early on, because it's going to be offset by losses. That's not necessarily the case if you take it in your name individually, right? You may not have other losses that you can use to write off that income. And those other losses, even if you do have some, may have no impact on your eligibility for public benefits. So think very carefully about the repercussions of you accepting any grant money in your name. I strongly advise you to accept it in the name of the business and make sure that your partners credit the value of that grant to your capital account. That is your contribution to the business. A couple other sources of capital funding here. Government subsidies, okay? Again, there are different types of capital. We're largely talking about money coming into your business, but I mentioned earlier on, if somebody wants to contribute intellectual property, that is a contribution. If somebody wants to contribute equipment or real estate, those are contributions, right? The way I think about these government subsidies, if you are eligible, if your business is eligible for a government subsidy because of your equity status, the business is now saving money because of your equity status, right? A subsidy may not necessarily mean money actually coming into the business, but it could reduce the money that's flowing out of the business, right? So, for example, the state of California now has fee waivers available for equity qualified businesses, right? That subsidy is being paid for by the state of California taxpayers, right? But your business is only eligible for it because of your equity status. So again, as long as your business remains equity qualified and you are eligible and receive these fee waivers, similar to the grants, the value of that savings should be treated as part of your contributions to the business. That should increase the value of your capital account. And the same thing if you are eligible for tax credits or tax rebates on account of your equity status. I don't know if Los Angeles has done this yet, and so this may be something you want to check in with the DCR on. But some jurisdictions are now offering tax credits or tax rebates, whether it's just standard as being equity qualified, you're eligible, or whether there is an equity hiring component that would make you eligible for this. As long as that is tied to your equity qualification, that is also your contribution to the business. These are credits and rebates the business would not otherwise be eligible for, but for your status, right? I'm going to be saying that a lot, but for you, okay? If you walk out of here with only one thing today, I want you to walk out of here knowing that you are valuable in these businesses, that these businesses need you, that these licensing opportunities would not even be there but for you. And I think if you go into these conversations with a healthy understanding of that, it is much less likely that they'll be able to take advantage of you. Okay? The last form of capital, alternative capital I'm going to talk about on this slide is trade credit. This has less to do with your equity status, but it is a way to reduce your initial capital cost of getting a business off the ground. By show of hands, how many of you are pursuing a retail license right now? Okay, so there's a couple of you. Trade credit is going to be really important for your retail business. A retail store can spend anywhere from $100,000 to $500,000 just getting its initial starting inventory in. If you have some relationships with distributors, if you have relationships with manufacturers and cultivators already, and you can get them to extend you some trade credit on bringing in that inventory, that is going to reduce the pressure on you to raise a significantly higher amount of capital out the gate. Okay. And for those of you who are unfamiliar with the concept of trade credit, this is not a credit card or a loan or something that you apply for. It is just a relationship that you have with your vendors, right? A lot of people think of them as terms. I need terms on my purchase, whether it's 30 days, 45 days, 60 days. We don't like to use the consignment word because by state statute, consignment is not allowed right now. But if you think about it, what really is the difference between consignment and 120-day terms, right? Some of these products are not even shelf stable that long, and they're going to turn over faster than that. And even if they are shelf stable that long, the testing is only good for 6 months usually, right? They're only going to stand behind their testing on the product for 6 months. So if you can negotiate particularly extended terms, that's about as close as you're going to get to consignment. But it will save your business money, right? It'll give you an opportunity to sell through that product before you have to pay off your vendors. And so again, that's less capital that you need to bring, right? I love these sorts of gatherings where we can get equity operators in the room together talking about these sorts of issues, because almost every partner you will come into contact with, every prospective investor, they all got a guy, right? They got a guy who does distribution. They got a guy who has cultivation. Oh, you don't need to worry about that. I'll get my guy. We'll bring in all the inventory, right? There's a lot of issues with that. And we don't have a time here today to go through all the nuance of that and what that could mean for your partnership. But it's not necessarily a bad thing. What I want you to walk away with on this point is that you can bring those relationships to the table too. Again, that increases the value of what you're bringing to the business. But more importantly, if you want equity cannabis to be sustainable, then we have to lift up the equity operators up and down the distribution chain. Not just equity retailers, but equity retailers should be really keen on, am I carrying equity products in my store? And if I am carrying them in my store, are they on the back shelf where nobody's going to see them? Or am I showcasing them? Equity operators, again, by definition, are under-resourced. We are looking to cut deals with each other. We are looking to support each other, and we need to support each other. I cannot say enough how incredibly important it would be for just the people in this room to work collaboratively. I saw that there's some retailers in the room. I saw that there's some manufacturers. I didn't ask about cultivators. Are there any cultivators in the room? A couple, okay. Are there any distributors in the room? So all of you, I hope that when we get to networking today, that all of you are talking to each other, that you are sharing your information and building those relationships. You don't want to be reliant on whoever your partner's guy is. Okay? Build those relationships yourself. It will reduce your reliance on your partners. It will increase the value of what you bring to the table in your partnership. And it can help sustain this community of businesses. So let's get to some of the meat of this. We're going to talk about capital structures here now. And a capital structure at a very base level is the combination of all the different sources of capital in your business and what proportion they have, right? Are you 50% debt? Are you 50% equity capital? Is it some other combination, right? So I just want to demystify this a little bit, because people often come and ask me, what's the right structure? How am I supposed to structure this? And there is no, set recipe. There's no according to Hoyle, this is how you do it, right? It's about what's going to work for your business. And that's what I mean when you see it say optimal capital structure. The optimal capital structure for a cultivator may look very different than the optimal capital structure for a retailer. It may look very different amongst cultivators. If you're cultivating 20,000 square feet, your optimal structure may look different from the person who's cultivating 10,000 square feet. Your capital needs are different, right? Your starting capital, how much money you need to even get things started, could be different. For those who are cultivators, you'll know what I'm talking about. Do you have to bring in 100 lights? Do you got to bring in 20 lights, right? Do you have to redo the whole HVAC for the whole building? Or do you just need to install some carbon filters, right? You could be in very different positions just based on your own business circumstances. So I'm sorry if you were hoping to come to this presentation and I was going to tell you this is exactly what you do. A, you need this amount of equity capital, and B, this amount of debt capital. And it's not like that. You're not going to have that experience. But there is a way to think about this, right? Particularly if there is some flexibility amongst your partners in terms of how you bring the money in. I may have mentioned that debt capital traditionally is non-dilutive. And so I don't want you to run from debt. I want you to use debt wisely. Because if you can bring in debt capital to increase the value of your business, guess what? The value of your equity increases along with it without any dilutive impact. So there's some math to this that we're not going to bother with here for this presentation. But what I want you to take out of this is that there is going to be some balancing act that you have to do in terms of how you capitalize your business, the different sources that you're going to for capital, and the different deals that you structure with those sources. There's no one fit recipe for everybody. But again, this is where you should all be taking advantage of the resources that the DCR makes available to you. Talk to an accountant with a background in 280E. And for those of you that don't know, 280E is the IRS code that governs the taxation of cannabis businesses. Talk to an accounting professional. Talk to a legal professional through the DCR's pro bono, low bono program. How should we structure these things? What makes sense for my business? This is how much capital I think I need. This is how quickly I can get to sales. What does that mean for my business? And how do I balance these things? I can't give you that answer today, but doing your homework on your own business, particularly around the money side and understanding your financials that you're projecting, you can go have these conversations with the professionals and they can guide you on the right path. It is incredibly important that you do so. So, how do we design these capital structures, right? And this is where I was talking about really needing to balance what's right for your business. Is it exclusively debt? That's probably not optimal, although that's what a lot of the investors will offer you out the gate. Is it exclusively equity capital? Very few investors in this industry will offer that. And again, I don't even know if that is the optimal strategy, even if you can get it, right? If an investor is offering exclusively equity capital, they are going to insist on a big chunk of equity. That may not be the best deal for your business, particularly if you're thinking about growing your business. If you're one of these distributors and you have a depot on the east side of Los Angeles and you think that your business is scaling and now you need to add a second depot, well, if you didn't factor that growth into your plan when you originally decided how much capital you needed, guess what? You're right back in the capital market again. You're right back in it again. And if you've given up too much equity, that's going to limit the different avenues that you have to bring that new capital in. So these first two are probably not going to be optimal, even though one is what the investors are going to offer and the other is what we traditionally think of in terms of raising capital, right? Is it exclusively preference capital? In other industries, we see this a lot. Your Series A, your seed round, when you're bringing in the early money, it is almost exclusively preference capital. They're selling preferred shares. This could work for your business. But again, this is going to be a negotiation with your prospective investor. They may or may not be keen to this idea. So we're really more likely talking about the last three that you see on the screen. Some combination of those things is probably where your balancing act should land. Whether it's a combination of debt and equity, or debt, preference and equity capital, or just debt and preference. Okay? Be flexible about this, but also negotiate hard for your due. Okay?